Well, hey, folks, this is Marziti here. And, we've got all this talk going on about the wheel strategy right now. And you'll notice, so I thought I would do a little bit more in depth on, I did a video before on what it is and the concepts of it. Here, I want to do a little bit more about the minutia, big fancy word, of, well, how do you pick the stocks? And what's the right strikes and the right days to expirations and things like that. So that's kind of what we're going to do here in this video well, I say tonight, it is tonight for me as I'm sitting down here after the market doing this video. So here we are, Trading the Wheel Strategy Part 2. All right, let's get through the disclaimers and the legal parts. This is a presentation that I have created. I'm not a financial advisor. It's for educational purposes only. The video here does not necessarily represent the opinions of anybody in the Bullish Bears community. You yourself are responsible fully for your own trades, and you're welcome to redistribute this video so long as the author, in this case, me, Marziti, is given credit for it. Before we get started here, trading options can be significantly more difficult than regular stocks or futures. I've said this many times before that learning to trade price action is a bachelor's degree. Learning to trade options can be a PhD. And that is because there's so many ways to trade options. You've got just straight buying calls and puts or selling them, and then you've got spreads, and you've got butterflies, and then you've got all the different ways to manage a trade and so on. So that being the case, do you need to be a real master of options to trade the wheel? No, you do need to understand the basics of buying and selling a call and a put. That's the main thing you need to understand, the differences between buying and selling calls and puts, and what they mean, what your responsibilities are, different things like that. It is highly recommended that you have an understanding of the basics of options trading before you begin using the wheel strategy. So first of all, let's talk about coming up with choosing the symbols, the stocks and the ETFs that we want to trade. Now, there's many ways you can go about this. I have some basic criteria that I like to use in my as I look for scans or whatever it may be. I want to see at least $500 million in market cap. Now, some people like more, like a billion-dollar company or whatever. The point is I don't want to fly by night. I don't want a company that's worth $3 million kind of thing. There's just, because understand that the more money that a company has in market capitalization, they generally attract smarter people to run the company, which means that it's most likely going to whether, they're going to be, in good times, bad times, these smart people help keep the company moving in the right direction, and they're not as, they don't make so many bad decisions, hopefully, because of inexperience. We want the most expensive companies we can get as far as their market cap. Now, I'm not talking about the dollar, the close price. I'm talking about the market cap, because the more market cap, the more educated people running the company. Average daily volume, at least 1 million shares a day. More is better. Now, what is the significance of that? The more volume that you have per day, the better the options will be also. And what I mean by that? Well, some options you'll see the bid, let's just pick a number here. Let's just say that there's an option for $2. Okay, let's say the ask is $2. If it's a low volume company on the stock side of it, the option side of it, then the bid though, if the ask is $2, the bid might be $1.50. This humongous 50-cent spread in there. That's horrible. We don't want that. Well, that gap will close most often when you see that higher daily volumes. As that volume, if we find companies with higher and higher daily volumes, we'll also see the gaps in the options between the bid and the ask will tighten up more and more, and we want that tight as we can get it. So I want to see at least $1 million average daily volume. Okay. One of the interesting things about volatility with the wheel. Remember that in the wheel, we typically start with cash secured puts, and we're going to be getting paid the premium up front, much like we would pay our insurance company for our car insurance or whatever. We pay them a premium. Well, when volatility is high, premiums are higher. Remember that. The higher the volatility, the higher the premiums. Because why? Well, think about the fact that the premiums for homeowners insurance in a hurricane zone, homeowners insurance is going to be more for the same house. And on the coastal Florida, homeowners insurance is going to cost you more there for the exact same house versus central North Carolina. Why? Because it's more volatile. It's more volatile on the Florida coast, and as a result, they're going to charge more for homeowners insurance. Same thing here. If a company is volatile, then the premium that we would collect in doing a cash secured put is going to be higher. So I'm looking for that volatility. Now, HV stands for historical volatility. And that historical volatility, you can sample back as far as you want. I sample back a full year when I do my scans and stuff like that. But this just tells me just how choppy is the price for this company. On the other hand, IV, or implied volatility, is forward-looking, what we expect to happen 30 days forward, typically. Typically, we're looking at the options 30 days forward or at the price action, and we're saying how much chaos are we expecting between now and 30 days from now. And that is implied volatility. So historical volatility looks in the past. Implied volatility is an expectation of the future. I like to see them both kind of high. Now, remember, when we're talking about looking at our symbols, if you are going to take ownership of the stock, you got to be able to afford it. So we always have to look at the underlying price. And trust me, we're going to go through a lot of this. We're going to pull up Thinkorswim here, and we're going to look at a lot of this as we go through it. But remember that options control 100 shares. So if a symbol's price, for example, and let me just pop over here, let me get my magnifier up. This is Robinhood, and as of the time of this recording here, it is closed, it's after market hours, is $48.50. Well, remember, options control 100 shares. So if I took ownership of an option through an option, if I took ownership of Robinhood here, I would be putting $4,815 of my cash to buy 100 shares of Robinhood. So you got to ask yourself, do you have that much money? And are you willing to allocate roughly $4,800 into Robinhood? Now, I'm going to show you there are ways that you can kind of play with the wheel strategy without actually taking the stock. And that's simply going to be taking profit on your premium with the stops and all that kind of stuff, which you may be interested in that. So we'll see how that plays out. But just remember, you got to have the cash, and we'll talk a little bit more about that. Finally is the appeal. If you're going to do the wheel, you've got to remember that you very likely are going to take ownership of a stock. Now, we just looked at Robinhood, and you have to ask yourself, do you feel comfortable adding Robinhood stock to your portfolio? If you look at a stock and you say, that is trash stock, I don't want anything to do with it, I hate it, blah, 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 then you have to change. You can still employ the strategies here of the cash secured puts to try and make money on the premium, but you're planning on getting out of the trade and never taking the stock. And that's a fine play. And right now, this is March 26th of 2025. President Trump has come into office. He's introducing a lot of policies, and there's a lot of the markets are actually chopping around in a slightly bearish manner. And because we're seeing a lot of bearish activity with a lot of stocks, I'm taking profit instead of stock right now. But when things settle down, as they will, then I'll start fully trading the wheel. So there's two different ways you can do this. You can just do the cash secured puts to make short-term money, or you can actually take ownership of the stock. And again, when you take ownership of the stock through the cash secured put, you get paid the premium, and then you do the covered call and collect premium. And the truth of the matter is there's probably more money on the covered call side than there is on the cash secured put in many cases. That assumes that we got in at the right time and place. And we're going to talk about that too. So, all right, let's move on here. Entering the trade. Actually, you know what? Let's do this. Let's go over. I want to go over here to a scanner, and I want to talk about what are good candidates. What are my good candidates for the wheel? So let me get my magnifier up here. I'm in Thinkorswim. I'm in the scanner. The first thing I'm scanning, putting in there, I'm scanning all weekly options. Now, some people are perfectly fine doing monthly options. I like right now, especially in this market, because we've got a lot of chaos while things are in chaos right now with the change of presidents and the change of monetary policy. There's a lot of chaos. I want shorter term trades right now. And because of that, I'm scanning specifically weeklies right now. So, scanning weeklies. I'm also only interested right now, let's say, in ETFs maybe. We're going to look at it. We're going to expand this out some. But here, for example, I'm saying minimum of $2, maximum of, not 200, let's say $60. 500 million market cap. Here we see the average volume for 21 days, and 200 days must be at least $1 million. Now, this next line, you can do it if you want. You don't have to do it, but basically, I am looking for company ETFs that over the last 5 years that we are positive. In other words, I don't want to look for an ETF that's just been sinking and sinking and sinking. I'm trying to screen for ETFs here that have done okay, that have done well over the averaged over the last 5 years. Now, ETFs actually don't have announcements, so I don't have to worry about that announcement there, so I'll get rid of that. Now, let's just run this and see what I get, if anything. Okay, there we go. Now, we've got 5 tickers. Let's take a look at that. We've got 5 tickers right here that have met my criteria. Now, we're still ultimately going to have to go in and look at them individually to see if there's any money in their options. I can go ahead and tell you right now that SLV does not have any money in its options, so it's probably going to get kicked out of the treehouse here. But the point being is that this is a base criteria. Just looking at ETFs right now. Let's take a look over here on the right. We see that the implied volatility, and remember, implied volatility is forward-looking. It's the expectation. There's really only 2 here that I would say. Let me just sort it this way, and it's going to be these bottom 2, and that would be GDX and AGQ are the only ones that have volatility. Remember, the higher the volatility, the more the premium is. So let's just take a very quick look at that. Let's take a look at AGQ. What do I mean when I'm talking about that? We're going to come back to this a little bit more, but let's go over to the trade tab. Let's look at 10 days out. Let's go look at this. And I guess I need to shrink this down. Let me pull this in a little bit. Well, no. Okay, I want to stay here. Here's my put side. Here is at the money. Now, we're going to talk more about all this delta and stuff here, but my point being is here, and I'm just arbitrarily picking this number because we're going to talk more about these numbers here in a little bit. But let's just say right about here, the 42. The 42 is not a bad place to be numerically. We haven't looked at the chart, but just showing this here, notice 43 cents versus 45 cents. That is because, oh, you know what? I'm on Hood. Dadgummit. AGQ. Let's go over to AGQ. I'm on the wrong ticker. Come on, give it. Let's straighten this out. There we go. All right, AGQ. Let's pick right about here, the 41, for example. See this 35 cents versus 45 cents? You say, well, there's 10-cent spread in there. There's 10 cents between those. Now, when I find a stock or an ETF that has more daily volume, average daily volume, you'll see that this gap between the bid and the ask will typically tighten up more and more. So we got 10-cent spread here, but when we look at some other particular tickers, we may see that it may tighten up to 8 cents or 5 cents or something like that. Okay. And that's kind of what I'm talking about there, about that spread. But we're going to come back to this here in a little while and go and look at that in more detail. So let's go back. The first thing, in all situations, if it is a stock, check for earnings. You always want to be aware of earnings and to see if there's going to be an earnings coming up while you may be in your trade, because that can be an absolute blessing. It can be an absolute wreck, but it is going to do something. And you may not particularly like it. So unless you're really skilled at it, most people are going to they're not going to pick an expiration that's going to involve earnings, unless you specialize in that kind of thing. All right. So let's just say that I have a list let's just say I've got a list here of things that I have qualified and said, I like these. I want to look at these. All right. So I've come up with a scan or handpicked or somebody else's list or whatever it may be. And you've got this hunting ground right here. Okay. So now that I've got a hunting ground, we're going to start looking at the charts to see which one has a favorable entry. And what I want to do here, you have to decide what you like. Now, I've set this screen up on purpose here for our demonstration. You may like to use Bollinger Bands. All right. The Bollinger Band has a 20-day moving average in the middle, and then it shows the deviations from that 20 moving average. And the idea is to, when the price action is down here at the bottom of a Bollinger Band, you expect it to move back to the middle. And so this would be a great place to take a cash secured put. This is a horrible place to take a cash secured put. Let me zoom in on that just a little bit. Why is that? The idea with the Bollinger Bands is that it has a tendency to hit the bottom band and move to the middle. If it hits the top band, it has a tendency to move back to the middle. So it's constantly moving back towards the middle. It's called a mean regression trade. So this is a great place. Why is that? Well, price is closer to your strikes, and when the price is closer to the point you want to get into the trade, the premium's higher. The premium is higher, and the idea here is that it hit here, we kind of expect it now to go back to the middle, moving away from us. So as you know, in the strikes, the further you are in your strike from the at the money, the further away you are, the cheaper or the less money there is in the premium. Now, that may be great if you're buying an option, but we're selling them. We're selling them. So we actually want that number to be as big as we can get it. And the biggest it can get it is right down here when prices is below the middle, and particularly down here on this lower Bollinger Band area. This is where we would get in. We would never get in up here or here or really anywhere above the middle band. But so you may like Bollinger Bands. That may be your thing. You may like standard deviations. That's an idea. You might use something like a MACD to help you. Maybe you like moving averages. That's fine too. Or maybe you like something like the DeMark sequence counter. Let's zoom in on that. And you can see here, this is actually a horrible example, but you had a 1, a 2, these are bearish candles, bearish DeMarks, 3. This sequence actually is broken because 4 took out 1. If it stayed below the high of 1, then the DeMark sequence would still be running, but it's broke. Then again, you may go completely by price action, and you could say to yourself, here's a low, here's a high, here's a move back to the middle. I expect it to go north. If you're an ICT trader, you would say low, high, 50% retrace into a fair value gap. I expect it to go north. You might take your cash secured put and you say, when it's right here about where this number 2 candle is, you might say that's a great place to take the cash secured put. It doesn't matter as long as you have a good, consistent strategy. And so I've really got 5 different ways to look at this. And of course, you've still got raw price action, which, we could actually say would be 6 different ways. I've mentioned 6 different ways to look at getting into a trade. Bollinger Bands, standard deviations, some kind of an indicator like MACD, moving averages, DeMark sequence counters, or in general, just looking at the price action. So you've got to come up with some kind of a way, but the point is that we want it down here with some kind of an expectation that it's going to reverse at this point, that it's going to reverse. So here we say, it's fairly clear here, for example, on the standard deviation, because it hit, y'all can't see this that well, so it hit 1.5 standard deviation here. We expect it to go to 1.5 standard deviation on the other side and then reject it. So it hit over here. We expect the exact same move over here and then to reject. So there's that candle. If we look at it, the Bollinger Bands, same idea. All these are really the same idea. It's just which one of these do you like as far as where to get in. But we want to get in when the candle is on the downside here, because that's when the premium is better. Okay. All right, so let's say that we found a ticker that we like, a symbol, a ticker that we like. Then the next thing we're going to do is we're going to go look at the options chart. And we want to look at, first we have to pick our days to expiration, delta, premium, open interest. Let's do that. Let's take this, and actually I'm going to go back over to Hood because it had some pretty good numbers in it. Now, taking a look here, we see that Hood has weekly expirations, 2 days, 9, 16, so plus 7, plus 7, plus 7s. And the further we go out in time, the more money we get in the premium, because we are guaranteeing a price for a longer period of time. Therefore, we're going to get paid more money for that. But there's a flip side. You say, well, that's more money. More money is good. But there's a flip side to that. First of all, is that the further out in time you are, the greater the chance that the stock could crash on us. And I'm stuck in a trade that has gone south, and now I've got to figure out what to do with it. Sometimes the shorter duration trades are better because you can be in, you can be out, done, next. Now, you're not going to make as much money, obviously, on the shorter trades, but you can turn that capital over faster and faster and faster sometimes here. So let's just pick this 9. I'll take like a Monday trade. You come up here and it'll say, 4 or 5, whatever it is, kind of thing. I'll take a Monday, look at a trade on a Monday for the upcoming Friday. But once we get into Tuesday and some Wednesdays, there's no point in taking a 2-day trade. There's just not going to be any money in it. We'll take a look at that real quick just to see. Oh, we got to look at our chart, figure out where's a good place to get into Hood. Now, we're actually in the wrong place. As you can see over here, we're on the wrong side of the Bollinger Band. But we're going to pretend for a moment that this is a good place. And we're going to pretend that based on what I see on the chart, let's just say that let's just say that I would take Robinhood if it came back down to 45. I'm going to go with 45. If Robinhood came down to 45, I say, yeah, I would take it at that price. Okay. Now, so let's go over here to the trade tab. Let's look at first of all, we're going to look at this 45, and let's take a look at what we can see here. The first thing, well, actually, let me show you the columns here. Remember, there's the bid, there's the ask. We're going to look at the bid, the ask, delta, and the open interest. So first of all, we were talking about the 45. If I sold the 45, now we got 2 days, so it'd have Thursday and Friday. I would get paid. Now the markets are closed now, so obviously I can't do this. And when the markets open tomorrow morning, it'll be even less. But let's just say if the markets were open right now, I could make $37. Remember, options are times 100. 37, so we'll say it's 37 cents. Remember, that equates to $37. 37 cents minus commissions and fees. I could sell it for 37 cents right now. Typically, we try and negotiate and get a price in the middle, maybe like 38 or 39. Now let's go look here at delta. Notice this delta is 19. Now, what does that delta mean? Well, delta means two things. Number one, delta means that for every dollar price in the underlying, meaning that if this thing moves from 45 to 46, that this price will change 19 cents. Okay? So 37 will move to 40, 19, call it 20, 37, 57 cents, 57.58. And in fact, you can see that 37 to moving a dollar at 37 to 58 is about 20 cents. No, excuse me, 10 cents. No, wait, 37 to 57, 20 cents. So that's telling us that if it moves that dollar, it moves 19 cents. But it also tells us that the probability that we will end up at or below $45 by Friday the 25th is only 19%. In other words, we're saying that we have an 81% chance that the put will not hit, and we'll just pocket $37. Because remember, you only take ownership of the stock if it ends Friday at 4 p.m. Eastern, if you're at $45 or less. So if the price is $45 or less, you bought 100 shares of Robinhood at $45. So you'd have $4,500 tied up. But if it ends above $45, then you pocket that 37. So the next question we ask, well, what are the odds that I'm going to pocket the 37? Well, it's saying there's a 19% chance, roughly. In fact, some platforms will give you probability in the money. And they're in the same ballpark here. This says 21.5%. This says 19%. Saying there's only a 19 to 20% chance that you're going to have to buy that stock. Meaning you've got approximately an 80% chance that you will not have to buy that stock, and you're just going to pocket $37. Okay? So Delta is kind of also the place we go to find out the odds. Now, let's just say that you want to make the premium, but you really don't want to take the stock. Well, then maybe we might push out here to the 43. Well, okay, it's only $15. It's not a lot of money, but it adds up, possibly. And I'm going to talk more about these columns here, but it'd be $15, but you've got about a 10% chance that you're going to have to buy this stock. Meaning you got a 90% chance you're just going to pocket the money. Okay? So that's the importance of delta. any time we are looking at an option, you always want to look at the open interest. Always, 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 always want to look at the open interest. Because open interest, now remember the difference between open interest and volume. Open interest, listen carefully, open interest is the number of contracts that were open and running when the market opened this morning at 9:30 a.m. Eastern. When the market opened, that meant these were the contracts that were left open and running from yesterday. So when 4 o'clock hit and options stopped trading on Hood, whatever the open interest was at that time, wherever the books stood at that time as far as the number of contracts that were still open and running, that becomes the open interest today. This number does not change throughout today. Volume changes. So remember that open interest is yesterday's close, this morning's open. Open interest only is updated around midnight, typically. That doesn't matter to us, but the point being is that come 9:30 in the morning when the market's open, this number will not change at all during the day. But you take this number modified by volume, which happens today, to come up with the new open interest for tomorrow. So two things to understand about open interest. Like I said, number one, it doesn't change in today. Number one. Number two, it does not tell you whether people are long or short. In other words, did they buy an option or did they sell an option? It doesn't tell us that. We just know that there is a trade here that is still open and running. That's all we know. We don't know if, 2,000 people came in here and bought this option, this put, or did they sell it? We don't know the direction. We just know that there's a lot of activity. Now, the point being, though, is that the last thing you want to do is to take a trade when you have something like this. See, there's no open interest here. You don't want to be in a zero or anything like that. In fact, generally speaking, you want to see 30 to 50 times the number of contracts minimum. So if you're thinking about say 2 contracts, you're going to want to see at least 60 to 100 on a line here. So like this 120 is fine. That 40, not necessarily, because there's just no interest here. And here's the thing you got to remember: if you plan on closing your trade, if you plan on letting it ride to expiration and you're going to take the stock, well, you don't care. But if you think you may want to close it for whatever reason, you need to see open interest and volume here. If you don't have any open interest and volume here, you can get stuck in your trade. So I always want to see open interest here. Now, the next thing I want to look at, remember, volume starts at 0 at 9:30 in the morning. Open interest is what's carried over from yesterday, but volume starts at 0. So if you jump right in to start looking for these trades first thing at 9:30, you may not have any volume here. That's normal. That's perfectly normal. All right. Now, let's go back over to Hood. But if you come in here and it's 1 o'clock in the afternoon and there's no volume here, now you got a problem, as far as looking at this. So I want to look at this open interest. I want to look at volume. And You might also look at ROR, called return on risk. Now, what does that mean? Well, that means that if you pocket this money, so let's say we were talking about the 45. So let me zoom in on that so you can see it. This is the ROR, the return on risk. So notice we've got nice open interest. We have nice volume. And I got a .86. Well, what does that mean? Well, if it was 1, like here's 1.07. So let's just pretend this is 1 for a moment. Well, it means that if the underlying price, let's say, was $100, then 1% of that would be $1. It's the ratio of the mid price between these two numbers, the ask and the bid, divided by the price of the stock. So it's called your return on risk. Now, why is that significant? Well, let's just say, now remember, this particular ticker here has a whopping 2 days to go. Let's go out to 9 days. And let's go back to that 45. Now, let's just say this is 2 weeks. It's less than 2 weeks, but just for the argument's sake, let's say that it's 2 weeks until this. Let's say this is Monday, and this option expires in 14 days, or 2 Fridays away. Well, do you realize that means you're making 1% on your money every week? You're making 1% on your money because that's 2%. That's 2.33. Let's just call it 2. That means you're roughly making 1% each week, and you're in the trade for 2 weeks, so 2%. Well, that means that if you had a $10,000 account, if you could make this kind of trade every week, 1% a week, 1% a week, 1% a week, that would mean that at the end of the year, you'd make 50%, 52% on your account, which means your $10,000 account would be $15,000, not counting compounding. Now, granted, and of course, consistencies, you're going to have winning weeks and losing weeks and all that. But the point being is that what you don't want is you have to remember that. Let's just go to these short ones here. This kind of stuff like this, there's no money. There's no money here. You're not getting a good return on your money spending it here because there's no return for it. This would be like going and buying a CD. And they come up and they tell you, well, it pays 1%. And you're like, wait a minute, there's 4 or 5% CDs out there. Why would I get one at 1%? Same thing. If the return on risk is not there, there's no point in it. Now, you may not have return on risk in your platform. All you got to do is divide the bid number here by the stock price. And that's what your return on risk is. Now, so what else can we learn from looking at this? Oh, let's look at something else. Remember here, I'm just picking this number arbitrarily. Here, this 40 strike here shows a whopping $6. 6 cents. It'd be $6. $6 in premium. But what does your broker charge you to make the trade? Now, if you're on something like Robinhood or Webull or Tradier, and you're on a paid plan on Tradier, you'd say, well, they don't charge me anything other than the exchange fees, which, 20, 30, 10, 15 cents. But if you're on Schwab or you're on Tasty Trade or something like that, you're going to have at least $1 in commissions. So you can say, well, I make $6 here, and it's very, it's got a delta 3, so I've got a 97% chance of pocketing $6. No, you're not, because you're going to pay $1 in commissions, $1 to $1.50 in commissions against your $6. You're spending over 20% of your profit. You're giving up 20% of your profit in commissions. Hope you see that there. So we want to look for some bigger numbers. We want to look for numbers where it makes sense, where it makes sense to tie up that money for this amount of time, where it makes sense that when we factor in commissions and stuff, that we're getting at least 95% of our profit after commissions and all that kind of stuff. So there's several things to look at in this table and consider. So again, there's got to be enough profit in the bid. The delta tells us roughly the probability that of the stock of, us having to take ownership of the stock. The open interest absolutely must exist, unless you plan on letting this ride completely to expiration and don't care. But if you have any thought that you may want to close this trade out and take profit on it before expiration, you absolutely must have open interest here. All right? Because if you don't, that means there's nobody interested in helping you get out of your trade. All right, that was a lot of time spent on these kind of things here, but I hope you've gotten the ideas. We're going to come back and talk about earnings here towards the end when I talk about something called IV Crush. And it's not just for earnings also. It can be for major news announcements as well. But we're going to come back and talk more about that topic later. Couple questions here you may ask yourself. Do you want to use an OCO? One cancels the other, aka also known as a bracket order. Now, just a quick thing here, an OCO simply has, excuse me, an OCO has two numbers, or two parts to it. One is if price gets to a certain point where I take profit, then close the order, or if it hits my stop, then close the trade. Okay. Now, remember, this is going to sound weird, but listen to me very closely here. If you are used to using OCO orders on like futures trading, when you sell when you do a cash secured put, you're selling an option. You're not buying it. You're selling it. Everything's reversed. Everything is reversed in your OCO orders. Now, your broker will handle this for you, but you're going to be surprised that your take profit is actually going to be like 5 cents. So let's say that you get in a trade, it's 50 cents. Matter of fact, let's just set one up to show you how that might look. So I'm going to click right here. No. Yeah, I am. Okay. And I'm going to set up first triggers OCO. Create an opposite. Create an opposite. One will be a limit. One will be a stop. The stop, because you're selling this, normally you would think the stop would be a lower number, but it's not. It's the higher number. My stop, let's see, might be 50, 60. Let's go 2 to 1, so that'll be what, 74. And my take profit And I'm going to zoom in on this in a moment. Here, let's zoom in on that now. I want you to realize my stop is the higher number. Now, it's backwards from the way you think. My take profit limit order is the lower number. So they're giving me 37 cents up front. As the option decays over time, it loses value. If it reaches, let's say, 5 cents, close the trade, get me out of the cash secured put. I'm not interested in taking the stock. It's actually going out of it's actually going to expire worthless anyway, but I'm going to lock it in. And so I'd pocket 32 cents minus commissions. However, if the trade goes against me and I do not want the stock, then I'm going to put in a stop. And I'm willing to risk, because I'll have to, I'm willing to risk 74 cents, $74 on this trade. If it goes against me and it hits 74 cents, meaning I did a cash secured put, meaning a cash secured put is a bullish trade. So if the price starts coming actually bearish towards me, the cost of this put is actually going to start going up. And it'll be 38 cents, 39 cents, 40 cents, 41. And eventually at some point it could be 74 cents, which means that price is moving towards the point of me taking ownership of the stock. Well, if I actually just want to trade for premium and not the stock, then I need to put a stop in or manually watch my trades and manually close it. But you can do an OCO if you want. However, like I said, now figuring out where this number should be can be a little bit difficult because you can, let's see, go to trigger, and you could go to, let's say, 100%. And it'll figure that out. It'll actually be 74 cents, meaning that if you take a full, that's a risk 2 to make 1 kind of thing, or whatever. Okay. So you don't actually have to take it. You can just play for the premium, and that's fine. But the thing to understand is that most people make more money on the covered call that follows. So most people want to take ownership of that stock so they can do the covered call. Because they actually make a little bit better money there. At any rate, so this is totally up to you. There is one thing about closing a profit. Let's say it's trade at 75%, closing it. And that advantage to closing it right now is that you can immediately put that money back to use in a brand new trade instead of waiting, because maybe you've got a week until it closes, until expiration. Well, I could take 75%, let's say right now, because let's say it's been moved, the stock's price is moving away from me, the option price is dropping, and I say, you know what, I'm gonna take the 75% because now I can just go ahead and immediately enter a new trade instead of waiting an entire week. So sometimes just taking the cash secured put premium, closing the trade, starting another one is more advantageous. Okay. Let's talk about something called IV crush. Now this happens, I put the word earnings up here, but it also implies with big news events also, like FOMC and CPI and those kind of things. This is IV, implied volatility. This is days to expiration. when implied volatility goes up, the price of the options go up. Now that's good for us as premium sellers because we want them to give us more money, right? We want them to give us more money because it's a credit system. I mean, it's a when we sell the option, they give us cash. Well, we want more cash, so I want that IV to be higher. Okay. When we have something like earnings, as time moves by and we get closer and closer to the date of the earnings announcement, you will often see that the price of the options get more and more expensive. Why? Because it's the problem with earnings is, well, I won't say it's the problem, it's just the fact, is we don't know what they're going to say when they release their earnings. Did they beat their estimates or did they fail? Is their guidance positive or negative or whatever? We don't know. And because there's an unknown there, that creates uncertainty, which means implied volatility goes up. And as implied volatility goes up, premium goes up. Fine. The challenge is, or whatever, the thing to understand about earnings or major news events, again, this is not just earnings, this can be FOMC or whatever, is that once they have the earnings announcement, they have the phone call and everybody listens in and they give all their numbers and stuff like that, now we know. We know if they made their numbers. We know about their guidance. We know about it. We know everything. And the implied volatility plummets in most cases. It plummets. Now, the thing to understand here, if you buy an option, if you buy a call, let's say, you want to buy it here and sell it right before earnings because in theory, let's say you buy it for $1 here and you sell it for $5 there. On the other hand, if we are a seller of options and we get into this trade too soon, well, down here we don't make any money. And then we start seeing the IV going up and up and up, and the stock price doesn't have to move for the options to move. Let me repeat that. The stock price does not have to move for the implied volatility to affect the option price. Okay. Let's go back and look at this. I want to look at this here. Let's look at this trade right here. This trade on Robinhood expires in 9 days, or this option chain. If I come all the way over to the right here, look at these numbers, and it says implied volatility is 83%. And that the price of Robinhood can move from where it is right now, plus or minus $5.25. So let's just call it $5, which means that Robinhood right now is at $48, which means it could be plus or minus $5, anywhere between $43 and $53. $43 to $53 is what they expect this price range to be. When there is an event, an unknown event like earnings or whatever, these numbers will skyrocket. And when those numbers skyrocket, these bids and asks will skyrocket. There is another Greek. There's many Greeks in here other than delta, because there's delta and there's gamma and there's theta and there's rho and all kinds of stuff that most of us don't pay any attention to. But it's important to understand that when implied volatility goes up, the option prices go up. Now, that being the case, let's go back over here. So what happens, like I say, a lot of people, let's say they'll buy a call or they'll buy a put and it goes up and they don't get out in time, and then earnings hit and then blam, it crashes and they're like, I lost all my money. Oh my gosh, blah, 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 when they should have gotten in much earlier and gotten out right before the announcement. But we're option sellers. We want these kind of events. Actually, we don't want to be in these events. We really don't want to be in these events because price could go up. The IV can drop, which lowers the value of the option, which is good. But if the price takes off to the north, starts running hard to the north, well, that works against us. And so on the one hand, we benefit from IV falling, from IV crush, but if the price turns out to be, excuse me, I said that wrong. If the price is also bearish, excuse me, that's what I meant to say. If the price is also bearish, that's increasing the option while the IV crush is decreasing the option. And so we end up with a lot of conflicting things here. So it's best to stay away. When you're looking at the days to expiration, make sure you don't see an earnings or think about any kind of a news event like an FOMC or something like that that's coming up, that type of news report will directly affect, let's say, what you're trading. Okay. All right. Final thoughts. We're going long here. We've been going kind of long, so let's wind this down. How much cash do you need to wheel trade? You can get ETFs and stocks for less than $10. Like MSTU. Now, this one's a little volatile. It's a little tricky. But you can see right here it's under $8. Now, if you took a contract all the way to expiration and you got assigned, then you'd have to have $800 cash in your account because that's a cash secured put. You'd have to have that $800 or $784 or whatever it is, whatever your strike is. If you took the $5 strike, you'd have to have $500 in your account because you're insuring that $5 level. And so whatever your strike is times 100, you've got to have that much money in your account to cover it. So there are tickers down here as far as down in the lower price tiers. We can find those. We just have to be a little bit more careful with them sometimes. They may not have the market cap or the volume or whatever. We have to really closely evaluate them. But, there are trades available on the lower side. And, of course, there's stocks that are hundreds of dollars on the other side of the spectrum. How fast can you make money with the wheel? The wheel is not like day trading necessarily. You don't walk away and say, I made, all these thousands of dollars. The wheel trade is a slow and steady approach to making money. Now, it can be much faster than buy and hold of stocks. You could trade Google on the wheel, or you can just buy Google stock and hold it. And in some cases, the wheel makes better money. In some cases, buying Google stock and holding it for a year may make more money. We don't know necessarily, but the idea of the wheel is to be more slow and steady moving as far as making money. My targets in wheel trading are going to be to make around 25 to 50% increase in my portfolio. Those are my goals there. Can I make more? Sure, it may happen. But 25, I mean, you got to remember, this is the year 2025. Last year, the year before, the S&P was like, oh, we made 25% on the S&P, woohoo, woohoo, and we did 25% the year before, woohoo. Well, now they're only saying we're going to make 5 to 10%. You're like, well, I want to make 25% again. Well, you're not going to make it investing in the S&P right now if the analysts are correct. So you got to find a new way to trade to make that 25 to 30%. Wheel trading is one way to do it. All right. Finally, are all stocks and ETFs fair game for the wheel? Yes, but there are certain caveats. For example, whether you buy and hold or whether you trade or whatever, real estate stocks generate different taxes. You get what's called a K1 with a lot of real estate taxes. And if you've ever done your own taxes or had to deal with K1s, you know they're a pain in the butt. And so personally, I avoid any and all real estate and REITs, REITs, and stuff like that because I don't want those tax problems. Okay? Some foreign stocks like BABA, KWEB, I think it is, whatever, that are foreign stocks, you may have to remember that they're shown to us in U.S. dollars. However, their prices can change a little bit based on the currency pair. So the currency pair, if it changes dramatically, that change of it by itself could change the stock value here in the U.S., which would change your option price. So you kind of want to be, it doesn't happen much, it doesn't happen often, but it's just something to be careful about. We trade BABA, we trade all these kind of, a lot of foreign stocks there all the time. It's not a big deal typically. Just be aware that you may have some issues there. But anyway. And with that, I hope I've given you some ideas here of how to find things, decide whether you're going to just do cash secured puts just for the premium or whether you actually want to trade the wheel, and you can do either one. Like I said, there are times when it's faster just to go ahead and close the trade out. Take the profits that you made, close the trade out, because I can start a brand new one and make money faster that way. It's fine. So there's lots of different ways that you can do it. Now, there is one other caveat as I was winding down, and then it suddenly occurred to me. One last little thing, and that is, these are what are called American-styled options, as opposed to European. And what that means is that when you sell an option to somebody, let's say I come in here and I sell this 750. Let's just pick this out as a casual example. Let's say I sell this 750 put for 60 cents, which is $60, right? The person on the other side of that trade can, at his or her leisure, exercise before expiration. In other words, you could come in here and you can get a message saying, oh, you should be excited. You are now the proud owner of 100 shares of MSTU. And you're like, well, that trade still had 12 more days to go. But the person on the other side of this trade says, you know what, I think I'm going to go ahead and take that now. The person on the other side of that trade can do that. We're the sellers. Nothing we can do about it. But the person on the other side can do it, and it's called early assignment. And that can happen. Doesn't happen that often. It's very, very rare, but it does happen sometimes. So just be aware that there are certain little nuances that can happen when we're the seller of an option. Anyway, folks, I hope that I've given you some stuff some general ideas of how maybe to work this. We will be talking about our lists, what the tickers and symbols are that we like here between Jeremy and myself, talking more about that. But I hope that what I've shown you here today actually shows you some more of the mechanics and the thought process behind it. Certainly, always feel free to message us and give us ask us questions and things like that. We'll be more than happy to talk with you about these kind of things. So with that, this is Marziti, and I am signing out. Y'all be good, or at least be good at it. Bye-bye.